When a trader has a bearish outlook on a stock, they can short it or buy a put on it. However, there's another option available to them. Let's see what's behind door number 3. It's a brand new option strategy. That's right, it's buying what's called a put spread. And because this put spread is a bearish trade, it's also known as a bear put spread. Now, there are a few things to make note of when comparing a spread trade to a single leg trade. The spread trade has less potential for profit with less risk. The spread trade requires less capital or has a lower margin requirement. And because of that lower capital cost, the spread trade has a more favorable break-even point. If you feel like you need to brush up on single leg option trades, you can check out our introductory videos or join a masterclass before continuing with this lesson. But if you got a handle on single leg option orders and are ready to learn more, let's break down what a bear put spread looks like. The strategy is made up of 2 option legs. The first leg is a long put and the second leg is a short put at a lower strike price. Both puts have the same expiration date. Let's go through an example with our option trader Jack. Keep in mind, this example doesn't include commissions or any other fees. Commissions and fees can quickly inflate your trading cost, so ensure you're aware of your broker's fee schedule. Jack has a bearish outlook for ABC One Corp and thinks the stock has a good chance of falling from $50 to $45 within the next 30 days. He can buy a $50 put for $4. This makes his break-even point $46. His maximum profit potential is $4,600 if the stock goes to zero, and his maximum risk is the $400 premium he paid. However, Jack can choose to buy a put spread instead. He can buy the same $50 put for $4 and sell a $45 put for $2 to subsidize the cost. That will make his net debit $2 for a total premium paid of $200. That's also his maximum risk for the spread. In this example, Jack has the right to sell the stock at $50 per share and is obligated to buy it at $45 per share. The difference between the 2 strike prices is known as the width of the spread. Knowing it is an important step in figuring out the maximum profit of a spread trade. Here, the width of the spread is $5, and Jack paid a net debit of $2 for the spread. This means that his maximum profit potential is $500 minus $200, for a total of $300. Calculating the break-even point is done in a similar fashion to the single put trade. We take the strike price of the put that was purchased and subtract the net debit from it. Jack bought a $50 put and paid a net debit of $2, so his break-even point is $48. Keep in mind the break-even of a spread should always be between the 2 strike prices of the spread. Lastly, Jack's maximum loss for the spread is the premium he paid of $200. Now that we've established the risk and reward for each trade, let's compare them side by side. The single leg trade has a maximum theoretical profit potential of $4,600, but the spread trade is limited to a maximum profit of just $300. That's a huge difference. The break-even point of the single leg trade is $46, compared to the $48 break-even of the spread trade. The maximum loss for the single leg trade is $400, whereas the maximum loss for the spread trade is only $200. As you can see, the single leg trade offers the greatest potential for profit, but it also costs the most. The spread trade, on the other hand, may not offer as much potential profit, but it is cheaper, not to mention profitable sooner than the single leg trade. So how does Jack choose which strategy to trade? Well, he can evaluate how each trade might look if his prediction about the underlying stock were to end up being correct. If the stock did fall to $45 at expiration, then the single put would be worth $5. If we subtract the $4 Jack initially paid for the put, he'd be left with $1, giving him a total profit of $100. Now let's look at the spread trade. Jack's long put would again be worth $5, while his short put would be worth $0. Jack paid a net debit of $2 for the spread. And since the stock would be trading at the strike price of the put Jack sold, his trade would realize its maximum profit of $300. Of course, Jack knows the stock may not do what he expects. So, he'll also need to consider if the additional costs of the single put trade are a worthy trade-off of the greater profit potential in the case of a bigger stock price decline. Let's summarize what we've learned about buying a put spread. It can also be referred to as a bear put spread. The strategy is made up of 2 option legs with puts. The first leg is a long put and the other is a short put with a lower strike price. Traders want the underlying price to go down. Their maximum profit is limited to the spread between the strike prices minus the net debit paid. Their maximum risk is the net debit paid. And their break-even point is the strike price of the long put minus the net debit paid. So whether a bearish trader shorts a stock, buys a put, or buys a put spread, one strategy isn't universally better than another. That's the flexibility options can provide traders. They can choose what's behind curtain 1, 2, or 3 depending on their outlook and risk tolerance.